On the same day in January of 2026, two separate research organizations published two separate analyses of two supposedly separate housing markets and arrived at the same conclusion using different words in different currencies about different cities in different countries. In Washington, D.C., the American Enterprise Institute Housing Center published data showing that the United States National Single-Family Home Price Index had slowed to 1.1% year-over-year appreciation, the lowest reading since the AE began tracking in 2012, and projected that the trend would turn negative. In the first weeks of April of 2026, in Montreal, Canada, the RPS-Wahi House Price Index published its January 2026 reading showing that Canadian national home prices had fallen 2% year-over-year, the largest annual decline in 2.5 years, driven by inventory overhangs and buyer fatigue in the country's two largest markets of Toronto and Vancouver. Two countries, two research organizations, two currency systems, two central banks with different policy rates. One synchronized housing correction that nobody is talking about as a single phenomenon, and that is precisely why it is the most dangerous economic development of 2026. The silence is not incidental. The financial media covers housing markets the way political media covers elections, as national stories with national narratives, where Canada's market is one story and America's market is another story, and any overlap in their direction is coincidence rather than architecture, but the architecture is the story. The United States and Canada have built their national economies on the same structural foundation over the same 30-year period, the assumption that residential real estate, funded by mortgage debt at rates calibrated for a low inflation, low-rate macroeconomic environment, would perpetually appreciate, perpetually accumulate equity, and perpetually provide the middle-class wealth creation that every government in both countries sold to its citizens as the definition of economic success. That shared foundation was stressed simultaneously by the same interest rate normalization cycle. It is now cracking simultaneously under the weight of the same affordability collapse, the same mortgage lock-in effect, the same investor retreat, and the same oil shock-driven consumer confidence compression that is suppressing demand. In both markets at the same time, the collapse is silent because it does not arrive with a single visible moment. It arrives the way the American Enterprise Institute described it in January, negative in the first weeks of April. The way the Real Estate Institute of Canada described it, prices declining further before more buyers are coaxed off the sidelines. The way CMAH described it, demand expected to remain below historical averages throughout 2026 with housing starts declining until 2028. This video is going to show you the complete picture of the synchronized collapse, the specific structural parallels between the American and Canadian housing markets that make them expressions of the same phenomenon rather than coincidentally correlated events. The exact data points, current and verified, that document the simultaneous deterioration, the specific transmission mechanisms by which the United States tariff regime under the Trump administration has added an external pressure to the Canadian housing correction that ensures it deepens rather than stabilizes while American policy uncertainty persists. The three historical synchronized housing corrections between these two countries that confirm the pattern is structural rather than coincidental. And what the synchronized collapse means for every investor, every homeowner, and every financial institution with exposure to North American residential real estate. Every fact in this video is verified, sourced from the American Enterprise Institute Housing Center Analysis, the CMAH 2026 Housing Market Outlook, the Canadian Mortgage Professional February 2026 Analysis of the RPS-Wahi House Price Index, the Real Estate Institute of Canada 2025 Review, and 2026 Outlook, the Pegasus Lending May 2026 Analysis of Canadian Housing Crash Probability, the Global News CMAH Housing Recession Report from February 26 of 2026, the AE Housing Center Projections for 2026 through 2028, and current May 2026 US, and Canadian Housing, Mortgage, and Economic Data. Let us start with the structural parallels, because understanding why these two markets are synchronized requires understanding what they share, which is more than most analyses of either market individually acknowledge. Both the United States and Canada experienced pandemic-era housing price surges of similar extraordinary magnitude. In the United States, the median home sales price rose from approximately $292,000 at the start of 2022 to $410,000 by the second quarter of 2025, a 40% increase. In Canada, the national average home price rose from approximately $530,000 Canadian dollars in early 2022 to a peak of approximately $816,000 Canadian dollars in February of 2022, a 54% increase in approximately 2 years. Both surges were driven by the same three forces operating simultaneously: near-zero interest rates making mortgage debt artificially cheap, pandemic-driven demand for larger homes with remote workspace, and supply constrained by construction disruptions and land use regulations that had been accumulating for decades. Both markets peaked at valuations that were disconnected from income levels by margins that every serious housing analyst described as unsustainable. And both markets entered 2022 facing the same fundamental correction mechanism, the normalization of interest rates toward levels that reflected actual inflation and economic conditions rather than the emergency pandemic-era suppression that had temporarily made unaffordable prices appear affordable, the specific parallel. Inaffordability deterioration is the most precise expression of the synchronized nature of the collapse. In the United States, a typical mortgage payment now consumes over 30% of median household income, compared to 21% pre-pandemic, according to the AE analysis. In Canada, the CMAH stated in its 2026 outlook that elevated price-to-income ratios, high carrying costs, and lingering job uncertainty will keep many buyers on the sidelines. In both countries, the ratio of home prices to household incomes is at or near the highest level in the modern era of mortgage financing, and in both countries this ratio can only normalize through one of three paths: significant price declines, significant income increases, or significant mortgage rate reductions. In both countries, the Federal Reserve and the Bank of Canada have followed divergent paths toward rate normalization, with the Bank of Canada cutting its policy rate to 2.25% while the Federal Reserve holds at 3.5 to 3.75%. But in both countries, the mortgage rate that actual homebuyers pay is still elevated relative to the income levels that would make purchases affordable without straining household budgets, and in both countries the fundamental affordability problem that the pandemic surge created has not been resolved by the partial rate relief that has occurred, verified, in the CMAH report, in the AE data, in the Reich analysis, in the Pegasus mortgage analysis. Now let us understand the specific data points that document the simultaneous deterioration in both markets, because the parallel in direction is as important as the parallel in structure. In the United States, the AE Housing Center's projection is among the most specific and sobering in the public domain. National single-family home price growth will turn negative in the first weeks of April of 2026, remain negative for the full year at approximately 1% below the prior year's level, then decline a further 2% in 2027 and a further 2% in 2028. 3 consecutive years of nominal price declines. This projection is based on the E-zone tracking of actual transaction prices in the markets it monitors, not on modeled assumptions about future economic conditions. The direction is already confirmed. 28 of the 53 largest American metropolitan areas recorded year-over-year price declines through February 2026. Cape Coral, Florida is down 9.6% from its prior year level. Northport, Florida is down 6.1%. Memphis, Tennessee. Tucson, Arizona, Palm Bay, Florida. The decline is not yet national in scope but is national in trajectory, spreading from the most overheated Sun Belt markets toward the broader national average as the combination of elevated rates, insurance cost escalation, and new supply from the pandemic-era construction boom depresses valuations. Across an expanding geography, in Canada, the MLS Home Price Index sits approximately 20% below its early 2022 peak as of the most recent published data. The national average price, according to the Canadian Real Estate Association, has been under sustained downward pressure in the major urban markets. The RPS-Wahi House Price Index published its January 2026 reading at negative 2% year-over-year, the largest annual decline in 2.5 years. The Greater Toronto Area condo sector has been described by every major Canadian real estate organization as experiencing a glut of unsold units and vanishing demand. The Canadian Mortgage Professional Analysis published February 19 of 2026 documented that price declines across all property types are spilling into 2026, with condo values falling faster than single-family homes, and that the pattern is driven by Toronto and Vancouver, where national condo softness reflects an inventory overhang and buyer fatigue. The Real Estate Institute of Canada published its analysis in January 2026, expecting prices to decline further before more buyers are coaxed off the sidelines, which is the precise language of a market where the fundamental affordability problem has not yet been resolved and where the equilibrium price level that would attract buyers back in volume has not yet been reached. The Bank of Canada's policy rate at 2.25% in early 2026, after a series of cuts through 2025, is below the Federal Reserve's 3.5 to 3.75%. This rate differential means that the mortgage rate facing Canadian homebuyers, while still elevated by historical standards, is lower than the 6.24% as 30-year fixed rate. But the CRE noted that Canadian fixed mortgage rates ticked higher in March 2026 due to bond yield movements, reflecting the same dynamic visible in the United States. The global bond market, influenced by oil shock-driven inflation fears, is pushing long-term rates higher regardless of central bank policy rate decisions. Both countries are experiencing the same fundamental disconnect between central bank policy rates and the market rates that actually determine mortgage affordability. The synchronized deterioration is also visible in the construction data. In the United States, new home inventory rose to approximately 9.7 months of supply in January of 2026, matching levels seen at the start of the 2008 financial crisis. In Canada, the CMAH projected in February 2026 that housing starts will decline from the current level all the way through 2028 as developers face high construction and labor costs combined with weak demand. Two countries. Two separate construction markets, both simultaneously producing the same forward signal. Supply is declining because the economics of building new homes at current prices and costs do not work, but that supply decline will not rescue prices in the near term because the existing inventory overhang, particularly in condominiums in Toronto and Vancouver and in single-family homes in Sun Belt American markets, is still sufficient to keep prices under downward pressure for years. Now let us understand the specific role of the United States tariff regime in the Canadian housing correction, because this is the dimension that transforms what might otherwise be a parallel but independent correction in both markets into a genuinely synchronized collapse driven by a single cross-border transmission mechanism. The Trump administration's tariffs on Canadian exports, which the CMAH confirmed have dented the Canadian economy and job market especially in aluminum, steel, lumber, autos, and automotive parts manufacturing, are having a housing-specific impact in Canada that operates through multiple channels simultaneously. The first channel is the employment and income channel. Canadian workers in tariff-exposed industries, specifically the manufacturing and resource extraction sectors that are concentrated in Ontario, Quebec, and British Columbia, which are also the provinces with the most overheated housing markets, face the direct income uncertainty that the CMAH described as lingering job uncertainty. That will keep many buyers on the sidelines. Buyers who are uncertain about their employment income do not enter the housing market. Buyers who have already entered and are servicing mortgages on the assumption of continued employment income in tariff-exposed industries face the specific stress of potentially needing to sell into a weak market if employment is disrupted. The second channel is the lumber and materials cost channel, which operates in the opposite direction but with equally significant housing market implications. Canadian lumber exports to the United States face tariffs that raise the cost of construction materials for American homebuilders. Higher construction costs are one of the specific factors the CMAH identified as preventing Canadian developers from building new units profitably, contributing to the housing starts decline projected through 2028. In the United States, higher lumber costs contribute to new home prices that are already too high for the buyers they need to attract. Both countries are experiencing the same supply-side constraint from the tariff regime's impact on construction materials, operating in the same direction, suppressing new supply in markets that were already facing inventory challenges from the pandemic-era construction boom, slower than expected sales absorption. The third channel is the macroeconomic confidence channel, which is less precise but equally documented. The CMCAHEHEHECC statement that U.S. tariffs have created a cloud over the Canadian housing market reflects the specific psychological dimension of economic uncertainty. When consumers are uncertain about the future trajectory of their country's relationship with its largest trading partner, they delay major irreversible financial commitments. A home purchase is the most irreversible financial commitment most Canadian families will ever make. In an environment where the Canada-US trade relationship is subject to sudden policy changes with large economic consequences, deferring that commitment is rational, and the deferral is documented in the below historical average demand that the CMAH is projecting throughout 2026. The American housing market experiences the Canadian trade uncertainty in the reverse direction. The tariff regime that is compressing Canadian demand is simultaneously raising the cost of Canadian lumber and materials in the United States construction market, keeping new home prices elevated above the levels that would clear the 9.7 months of new home inventory that is currently sitting unsold in American markets. The two housing markets are not just experiencing the same interest rate environment and the same affordability stress, they are experiencing each other's economic distress through the specific transmission mechanism of a bilateral tariff regime that is simultaneously compressing Canadian employment and income and raising American construction costs. Now let us look at three historical synchronized housing corrections between the United States and Canada, because the current pattern is not without precedent, and the historical episodes establish both the magnitude and the duration of what synchronized corrections produce when they run their course. The first historical synchronized correction is the period from 1990 through 1996. In Canada, particularly in the Toronto market, which had experienced a speculative surge in the late 1980s driven by the same combination of low unemployment, strong migration, and investor confidence that characterized the pandemic-era surge, prices fell approximately 25 to 30% from peak to trough and did not recover their late 1980s nominal peaks until the early 2000s. The second historical synchronized correction is the 2008 through 2012 period, which is the most thoroughly studied housing market decline in modern financial history. The United States experienced the more severe version of the correction, with national home prices falling approximately 27% peak To trough according to the Case-Shiller National Index. The synchronized nature of the correction was driven by the shared financial system. Canadian banks held securitized mortgage products, Canadian companies supplied materials to us construction, Canadian workers depended on us consumer demand for goods manufactured in Canada, and Canadian households' confidence was affected by the visible deterioration in American housing values that dominated North American financial news throughout 2008 and 2009. Canada avoided the worst of the American crisis partly because its banking regulation was stricter and partly because the Bank of Canada was able to cut rates faster than the Federal Reserve given lower starting inflation. Neither of those mitigants is available in the current cycle. The Bank of Canada has already cut rates substantially and the current rate is already near its floor given oil shock inflation, and Canadian banking regulation, while still strong, is exposed to the same commercial real estate and condominium sector stress documented by every major Canadian housing analyst. The third historical synchronized episode is the 2022 through 2024 correction that preceded the current cycle. Both markets declined simultaneously following the first interest rate increases from the Federal Reserve and Bank of Canada in early 2022. The United States experience was concentrated in specific high appreciation markets like Austin, Texas, where prices fell 22-25% from peak levels, and Phoenix, Arizona, and Las Vegas. The Canadian experience was concentrated in Toronto and Vancouver, where prices fell 20-30% from their February 2022 peaks. Both corrections were partially arrested by the interest rate pause and eventual cut cycles that began in 2023 and 2024, but neither market fully recovered its peak valuations, meaning the correction that is now resuming in 2026 is not starting from a fully recovered base, it is resuming from a partially recovered position that still carries significant embedded overvaluation relative to current income levels and current mortgage rates. Now let us understand the specific mortgage lock-in effect that is operating simultaneously in both markets and that ensures the correction will be prolonged rather than brief, because this specific mechanism distinguishes the current cycle from any of the three historical corrections described above. In the United States, the mortgage lock-in effect has been documented throughout this series. Millions of homeowners hold mortgages at 2.5–4% rates and cannot sell and rebuy without permanently doubling their monthly payment. The mathematical result is frozen transaction volumes, declining buyer pools, and downward price pressure as the only transactions occurring are forced sales or life event sales by people who must move regardless of cost. The National Association of Realtors has documented transaction volumes at or near 30-year lows as a consequence of this effect. In Canada, the lock-in effect operates through a different mechanism that produces similar results. Canadian mortgages are typically variable rate or fixed for terms of 5 years or fewer rather than the 30-year fixed product that dominates the American market. This means Canadian homeowners have already experienced multiple mortgage renewals since the 2022 rate increases and have already been forced to absorb higher rates at each renewal. The lock-in effect in Canada is not a locked-in rate but a locked-in purchase price. Homeowners who bought at the peak of 2022 at prices that reflected 3% mortgage rates or now servicing mortgages at 5–6% rates after 2 or 3 renewals are in negative equity or near negative equity positions. In the most overheated markets, selling into a weak market at 20–25% below their purchase price crystallizes a loss they cannot afford to absorb. Not selling means continuing to service a mortgage at a rate that may be straining their budget but does not yet force a decision. The rational choice for many Canadian homeowners in this position is the same as for American homeowners in the lock-in trap: stay and absorb the ongoing cost rather than crystallize the loss. The result is the same frozen transaction volume and declining buyer pool that is suppressing prices in both markets simultaneously. The Reich analysis from January 2026 described this specifically, noting that the lock-in effect curtailed housing mobility and that fewer move-up buyers meant dampened demand and capped price growth. They described investor activity as having fallen to multi-year lows in 2025 because negative cash flow on rental properties meant carrying costs spiked past rents in Toronto and Vancouver, where condo mortgage payments far exceeded rental income. This is the specific investor retreat that preceded the 2008 correction in the United States by approximately 2 years. Investors who had purchased properties for cash flow exiting when the cash flow turns negative, adding to supply as they sell and reducing demand as they stop buying. Now let us understand what the synchronized collapse means specifically for investors and financial institutions with North American real estate exposure, because the cross-border nature of the simultaneous decline creates specific risks that a single-country housing correction would not produce. The first specific risk is the bank exposure concentration. The major Canadian banks, specifically the Royal Bank of Canada, Toronto Dominion Bank, Bank of Nova Scotia, Bank of Montreal, and Canadian Imperial Bank of Commerce, all have significant United States operations alongside their dominant Canadian residential mortgage books. When the Canadian housing market is under stress simultaneously with the American housing market, both dimensions of their cross-border books face the same directional risk at the same time. The specific risk in the Canadian books is the condominium sector in Toronto and Vancouver, where CMAH expects the segment to remain soft through 2026 with a slow recovery rather than a rebound, and where the Real Estate Institute of Canada documented that investor activity has retreated sharply, leaving a supply overhang without the buyer pool that would normally absorb it. The second specific risk is the lumber and materials sector's double exposure. Companies that produce lumber and building materials in Canada, whose products feed both the Canadian construction market and the American construction market through export, face demand weakness in both markets simultaneously. Canadian housing starts declining through 2028 and American housing starts depressed by the 9.7 months inventory overhang, create a bilateral demand shortfall for Canadian lumber producers that is more severe than either market's weakness alone would produce. The third specific risk is the consumer spending transmission. Housing wealth is the single largest component of household net worth in both countries. When housing values decline simultaneously in both markets, the wealth effect that supports consumer confidence and discretionary spending operates in reverse in both economies simultaneously. Consumers who feel less wealthy because their home values are declining spend less on everything else. Corporate revenues fall. Earnings disappoint. Equity markets are affected through the valuation channel as the revenue growth assumptions that underlie equity prices prove optimistic in an environment of declining housing wealth. The synchronized collapse is not just a real estate story, it is a consumer spending story expressed in two currencies across two of the most closely integrated economies in the world. The fourth specific risk is the pension fund and institutional real estate exposure that is concentrated in Canadian-American cross-border portfolios. Canadian pension funds, including the Canada Pension Plan Investment Board, Ontario Teachers' Pension Plan, and Ontario Municipal Employees Retirement System, are among the world's largest. Institutional investors in global real estate, including us commercial and residential real estate. Their portfolios are simultaneously exposed to the Canadian residential weakness and the American commercial real estate stress that the Federal Reserve's own Financial Stability Report identified as a notable vulnerability, with 1,763 American banks carrying concentrated commercial real estate exposure above supervisory thresholds. Here is the complete picture of the synchronized US and Canadian housing market collapse. The United States National Home Price Index is projected by the AE to turn negative in the first weeks of April 2026, decline 1% for the full year, then 2% in 2027 and 2% in 2028. 28 of the 53 largest American metros are recording year-over-year price declines. Cape Coral, Florida is down 9.6%. New home inventory is at 9.7 months of supply, matching 2008 levels. The 30-year mortgage rate is 6.24%. FA delinquency is 11.52%. Foreclosure filings have risen for 12 consecutive months. Mortgage payments exceed 30% of median household income. The Canada National RPS-Wahi House Price Index fell 2% year-over-year in January 2026, the largest annual decline in 2.5 years. The MLS Home Price Index sits 20% below the early 2022 peak. Greater Toronto Area condos face a glut of unsold units and vanishing demand. Housing starts are projected to decline through 2028. The Bank of Canada held its policy rate at 2.25%. Fixed mortgage rates ticked higher in March 2026 due to bond yield movements. Investor activity fell to multi-year lows in 2025. Negative cash flow on rental properties in Toronto and Vancouver is forcing investor retreat. U.S. tariffs on Canada have dented employment in aluminum, steel, lumber, autos, and manufacturing. CMAH expects demand to remain below historical averages throughout 2026. Elevated price-to-income ratios and high carrying costs are keeping buyers on the sidelines in both countries. The mortgage lock-in effect is simultaneously freezing transaction volumes in both markets. New anti-flipping taxes and vacancy levies are reducing Canadian speculative demand. The oil shock from the Iran war is simultaneously compressing consumer confidence in both countries. Spirit Airlines ceased operations May 2nd. The April NFP is expected at 53,000 jobs. The Federal Reserve held rates with 3 hawkish descents. PCE inflation is at 3.5%. The IMF projects global growth at 3.1% in its reference scenario, with the US and Canada among the most affected developed economies. The synchronized housing collapse between the United States and Canada is not a coincidence. It is the output of a shared structural vulnerability, amplified by bilateral trade stress, transmitted through synchronized confidence channels, and now being compounded by the oil shock that is the same inflation pressure in both countries. Being imposed by the same geopolitical event in the same global energy market, the two markets are not correlated, they are connected. They share a border, a trading relationship, a financial system, a currency reserve framework, and a housing bubble that was inflated by the same pandemic-era policies and is now deflating under the weight of the same affordability mathematics. The silence around the synchronized collapse is not because the evidence is ambiguous. It is because the full picture requires reading the A data and the CMAH data and the Bank of Canada analysis and the RPS-Wahi Index and the Federal Reserve enforcement actions and the FDIC failed bank list altogether, simultaneously, as a single coherent story rather than as separate national narratives. The story is the same story. The collapse is the same collapse, the only difference is the currency. If this video gave you the complete verified picture of the synchronized US and Canadian housing market collapse that no single mainstream source assembles with this level of cross-border precision, subscribe right now because this is the standard of analysis I deliver every single week without exception. The next video is going to show you the specific cross-border financial transmission mechanisms that convert a synchronized housing correction into a synchronized economic contraction, the exact bank exposure data for the 5 major Canadian banks and their American subsidiaries, and the specific real estate investment trust and pension fund portfolios that carry the largest combined US Canada residential and commercial real estate exposure, giving every investor the precise data needed to assess their portfolio's geographic risk distribution before the synchronized collapse enters its next phase. Subscribe, turn on notifications, and watch it the moment it drops. The correction is documented, the synchronization is confirmed, the silence is ending.